Hey, welcome to the Deep Beat Explainer Financial Education series. Today, we're digging into a question that sounds simple but has sparked a century-long debate. What is investment risk? The answer is more complicated and interesting than you think. This episode is based on one of the chapters from my upcoming book, Stock Saga. Let's toss out conventional wisdom. Back in 1885, Andrew Carnegie gave advice that's the exact opposite of don't put all your eggs in one basket. He said risk isn't about spreading yourself thin, it's about focus. Know one thing so well you can watch it like a hawk. Carnegie started the conversation, but the catastrophic 1929 crash made everyone get serious. The Roaring Twenties ended, fortunes vanished, the Great Depression began. Suddenly, managing risk became about survival, sparking a 90-year quest to understand what risk really means. Out of that crash emerged two different approaches. The core question, is risk something you can measure mathematically, like daily stock price swings, or something more terrifying, like permanent loss of capital? This created two camps, academics and practitioners. Academics see risk as volatility, a numbers game of statistical ups and downs you can measure and manage. Practitioners see risk differently, not the bumpy ride, but the chance everything goes off a cliff. The academic school became known as asset allocation philosophy. The practitioners are come to known as security selection school. For the asset allocation camp, the goal isn't picking the next big stock, but managing market swings. This was built by finance giants, Harry Markowitz's 1952 portfolio theory, William Sharpe's beta in the 60s, and Eugene Fama's efficient market hypothesis in the 70s. William Sharpe's beta in the 60s and Eugene Fama's efficient market hypothesis in the 70s. Markowitz's foundation is diversification. Classic, don't put eggs in one basket. He called single company risk unsystematic risk, which you eliminate by spreading investments. But diversification can't save you from systematic risk. When the entire market tanks, that's where beta measures your unavoidable market exposure. For academics, investing is about managing volatility through diversification and understanding beta. You control the downside rather than just chasing profits. But Wall Street developed a different approach, security selection. For these folks, risk isn't spreadsheet statistics. It's the gut-wrenching possibility of permanent loss. Benjamin Graham literally wrote the book, publishing Security Analysis in 1934 when the crash memory was raw. Graham's message, stop gambling on market swings, start acting like a business owner, focus on what companies are actually worth. His process is detective work, not math. Step 1. Analyze the business, health, assets, earnings. Step 2. Determine intrinsic value, ignoring market noise. Step 3. The secret sauce. Only buy when you can get it for way less than it's worth. Graham called this margin of safety, your buffer if you're wrong. But Graham was smart. He knew brilliant analysis could be wrecked by one thing. He wrote, the investor's chief problem and worst enemy is likely to be himself. The biggest dangers might be inside our own heads, so we have two powerful ideas for external risk, market and business. But what if the most dangerous risk is you? This changes everything. Our psychology, emotions, and mental glitches create a separate risk category we must address. This insight came from psychologists Daniel Kahneman and Amos Tversky. In the 70s, their experiments destroyed the rational investor myth, proving we're wired with cognitive biases that make us do predictably irrational things. Take loss aversion. We feel losses twice as strongly as gains, so we sell winners too soon and hold losers too long. There's overconfidence and herd behavior, buying at tops when everyone's buying, selling at bottoms when everyone's panicking. Put it together and you get a clear three-dimensional risk picture. Dimension 1, market risk, defend with diversification. Dimension 2, business risk, defend with margin of safety. Dimension 3, psychological risk, defend with self-awareness. Smart investors don't pick just one approach. They understand all three. They diversify portfolios, research companies thoroughly, and work to understand their psychological triggers. So ask yourself, which of these three risk dimensions have you been forgetting? Thanks for your time with us. If you want to explore more finance and investing topic, you can dig into our channel.